Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of McDonald's, ticker symbol MCD. This is the 18th video in our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average. You can see a link in the description below to all the other videos. Once we're done with all of our analysis, we're going to take the results and we're going to try to convert it into 3 different portfolios: a value portfolio, a dividend portfolio, and a growth portfolio. So McDonald's is actually an interesting company from a business perspective. So McDonald's owns and operates a handful of restaurants, and then they franchise the rest. They're in more than 100 countries, and management has stated that it's their long-term goal for McDonald's to have at least 95% of their restaurants franchised, leaving just 5% of the restaurants for the company to own and operate. Now, with that 5%, many times what they do is that's where they experiment. They experiment with pricing, new products, things like that. So that's really why they want to keep some of them. So as of the end of last quarter, McDonald's had about 37,000 locations. Here's a chart of the number of restaurants that they had going back to 2008. And as we can see, that they've been steadily opening new restaurants every year. This is likely a good thing for growth and revenue, but we'll come back to that in a minute. Now we can break this chart down into franchises and company-owned restaurants. The orange bars are franchises and the gray bars are company-owned. Right now, McDonald's operates about 8% of their restaurants, so they're a bit above their long-term goal, but it's not too bad. Now, one of the interesting things about McDonald's is the way they set up their franchising. So they have the conventional franchise model, which basically the way that works is McDonald's generally owns the land that the restaurant is on. So under this model, the franchisee will rent the building from McDonald's, and they will pay them royalties, which is it's based on a percentage of the sales of that particular store. And usually McDonald's will throw in some minimums in there that the store has to meet. Now, McDonald's claims that this gives them significant free cash flow. I actually read that word significant in their 10K. And the very first thought I had when I read that they get significant free cash flow is that this is probably a good candidate to use discounted cash flow to try to value them. And I think it's important to keep this type of thing in mind. If you're researching a company and you come across something in your readings and the company says, oh, we have significant free cash flow, or our growth is better than peers, perhaps that company is giving you an indication as to how we should go ahead and try to value them. Now, we actually saw this thing in our last video, which was our JP Morgan analysis, and they did the same thing. There, they came out and said that they measure success in their business by looking at the tangible book value of the business. Well, what we ended up doing is we ended up using tangible book value as a way to value the company. Now, this doesn't always work, but I find that it's usually a pretty good place to start. Okay, going back to McDonald's. Now, the conventional franchise model isn't the only model that they use. They also have something that they call the developmental licensing model. And here, the franchisee, they're actually the licensee in this scenario, but either way, what they do is they put up all the capital. They own the land, they own the building, they own everything. They do all the fixtures, they set everything up. Then what McDonald's does for using the brand and for helping them with logistics and all of that, they get a percentage of revenue. Then they have their final version is called the equity investments. Now you may have heard back in 2017, McDonald's actually sold their China and Hong Kong businesses. Well, they retained 20% of that business. So that type of ownership would fall into that category. So we know what McDonald's does. They own restaurants. But how big are they really relative to the rest of the restaurant market? So according to a study done by Euromonitor International, the global informal eating out segment generated about $1.2 trillion in revenue back in 2016. That was the last data I could find. Now, this chart, this is the number of locations for many of the largest brands in the world. And as we could see, Yum Brands is the largest. They have the most locations. They own KFC, Pizza Hut, Taco Bell, and a handful of other brands. Then they're the green bars. Then McDonald's, they're the red bars. And you can see that they're the second largest. Now, I actually don't have Burger King on here, and they've done a lot lately. They, a couple of years ago, they merged with Tim Hortons, and they merged with Popeyes. So there's been a lot going on with that. I probably should have had them on the chart, but we're missing that one. But you can see that they would fall somewhere in between Wendy's and McDonald's. So they would be the third largest. Okay, so before we go ahead and try to value McDonald's stock, let's look at some of their numbers. So this is a chart of McDonald's revenue going back to 2008. And as we could see, they've been struggling a bit in recent years. Now, when we add net income, we can see that net income dipped back in 2013, but then it looks like it was either a little bit flat and maybe it moved slightly higher. Now, if we eliminate revenue, then we can get a better look at just net income. And we could see then that what actually happened is that net income went down in 2014 and 2015, but then it did in fact start moving higher. So in order for net income to move higher while revenue is going down, that must mean that they improve their margins. Now, we have to find out how and is it sustainable is ultimately the question. And that will be very useful to how we come up with the valuation. So here's net income margins. And as we can see, net income margins started moving higher right around when we would expect them to. Right now, they're right around 24%, which is the best level that they've been at over the past decade. Okay, so now that was expected, but it doesn't tell us why they improved. So now if we add EBITDA margins to this, we can see that EBITDA margins moved up right in line with net income margins. Now, since EBITDA is profit, or really earnings, which is the same thing, earnings before interest, taxes, depreciation, and amortization, then what this tells us is that margins did not improve. It had nothing to do with interest, taxes, or depreciation. So we've learned a little something. We've learned why it didn't happen, but we haven't really learned why it did happen yet. Okay, now moving up the income statement, we could throw in gross margins. And now we could see that gross margins, they're the red bars. EBITDA margins, they're the green bars. And net income margins are the purple bars. We could see that gross margins have moved up right in line with the rest of them. Now, this is good because this tells us that ultimately what must have happened is their cost of goods relative to revenue improved. Now, I did a bit of digging, and it seems that the improvement to margins apparently down the whole income statement were due to price increases. Now, this is dangerous because if they price themselves too high, their revenue will continue to decline. And no matter how good their margins are, the stock price is likely to follow suit. Now, before we take a peek at the stock chart, let's see what we think. Let's try to come up with our own valuation, and then we can see if it's worth buying. So this is our discounted cash flow calculation. And we're using consensus estimates for free cash flow going out the next few years. We're using a weighted average cost of capital of 7.4%. Then we used a perpetual growth rate of 2.5%. That's been our standard in all the research that we've done. It's about the long-term growth of the economy. It's nothing else. It's a bit conservative, but it's what we've been doing. Now, if you're wondering how we calculated these, you'll see a link in the description below for different types of videos that are tied to these topics. The biggest question we usually get is about the cost of equity. For that, we use the capital asset pricing model. There's a link in the description below to that video. So with these free cash flow estimates, we get a fair value of $163 per share. And this brings us to McDonald's chart. And as we can see, the stock has been up a bit recently. Now, if we look at their current PE valuation, we can see that their forward PE is about 22x right now. Their 3-year average for their forward PE is 21x, their 5-year average is 20x, and their 10-year average is just 18x. So it seems that, according to their own history, McDonald's may be a bit overpriced. That's true for the PE valuation and for our discounted cash flow valuation. Now, what I think happened is that I think investors went a bit crazy when they saw the improvement in margins. But unfortunately, that really won't be sustained for a long period of time. Now, we saw that McDonald's continues to open new stores, and that I know that they also had some pretty good same-store sales numbers. But in my opinion, if McDonald's chart were to revert back to any one of their averages, the stock price is likely to fall. Now, one thing that could change is that if perhaps they were to make a big acquisition, I know that Burger King made a few big acquisitions in recent years that helped them, get much larger. On the other hand, if they were to perhaps lower costs a bit and try to improve margins that way, I know that they have spent some time remodeling a lot of their locations, and that seems to be helping some of the same store sales growth, which is good from a revenue perspective, but we're going to need revenue to turn around. We saw what that chart looks like, and it doesn't look terribly great right now. So until they get that in place, I'm not sure how interesting this will be. For now, I think from an analysis perspective, I'm not too confident in McDonald's stock. Certainly not at this price. But what do you think? Do you think McDonald's is a good buy at this level? Let me know what you think in the comments below. And do you think it belongs in any of our portfolios? They do have a dividend yield of about 2.5%, which is slightly above the S&P 500. So perhaps they have a home in the dividend portfolio. But let me know what you think in the comments below. And if you haven't done so already, hit the subscribe button. And thanks for sticking with me all the way to the end of the video. And I'll see you in our next video. Thanks.